Welcome to the Wisdom Lifestyle Money Show. I'm your host, Scott Dillingham. Today I'm going to be going over how to recession-proof your portfolio. And I think we're at a very important time when this should be a focus of yours. So you look at all the turmoil that's going on with our financial markets, with our economy, with the US and Canada, right? The trade wars and all that good stuff. So the thing is every investor has an opportunity to optimize their portfolio at any point in time. Absolutely. But when things are good, we don't really think about it, right? We're like, okay, we have cash flow, things are great, yada, yada. But if you take a more proactive approach to your portfolio, you can make so much more money. And the side effect is it recession-proofs your portfolio. So I'm going to be going over a couple of the different things. I've got some notes here that I always repeatedly talk to clients about. So these are like the top things. So the other thing that I want to paint the picture of is, right, it's early 2026. There's more and more negative news of recessions and things like that going on. And I think, that is a great opportunity to buy. So like, I'm not scared of this market, and I don't think you should be either. I think there's always an opportunity in any market. It's just your strategy and your game plan needs to change. Okay. But specifically with rates, right? We know the Bank of Canada last year kept lowering and lowering and lowering and lowering. They're saying they want to raise. The banks are predicting by the end of 2027 that rates start to raise. So that gives us, a year and a half, let's call it. But the thing is they actually might drop and stay lower for longer, because if Canada's market's weak, they're not going to raise the rates. Do you know what I mean? They're going to spur the economy by lowering the rates. So then I just want you to think back to the COVID days, right? This same thing could happen. Right now we're in a renewal crunch. It's a massive wave of people renewing in 2026 and 2027 that have rates in the 1.5% to 2.5% range. So when they renew, their payments are going to drastically increase, making their payments hard to pay. And we could be entering in that cycle again. Maybe not. Hear me out here though. So if rates do artificially go down to help the economy continue to grow, and then it gets stronger, they're going to raise the rates again, right? So we're going to be there again. So this is why I think you should take the time to recession-proof, and maybe even we call it rate-proof your portfolio. And there's some things that you can do. So, the number one thing that I think that you should do is try to have a minimum of 3 months rent saved per unit that you have. And the reason for this is vacancy rates are going up across the board. There's multiple reasons why. But I think two that speak very clearly to me is when you look at the CMHC, MLI Select program, where people can build apartment buildings for as little as 5% in the deal, obviously pending qualification, of course. But when you have that, and then you have these people building all these apartment buildings, then you have the government of Canada who's doing, they're very much not against, but they've heavily slashed the immigration numbers. And some people think it's good, some people think it's bad. I'm not getting there or going there for political reasons, but the overall point is we're seeing apartment buildings get built, and we're also seeing immigration go down, right? So it's creating more units in the market, and we're seeing, it's rare, but we're seeing and hearing of large developers having these properties and they can't rent them out. So, and that's in certain markets, right? Not all markets, but they're offering incentives like 3 months free rent, or like all these different things just to get somebody, because the vacancy rate's so high. So you want to build in that reserve, because if it spreads deeper and further and longer, right, that could affect you. We don't want that to. So build in that reserve. And it can be hard, right? Like, especially if you're just breaking even on those properties. We have some things to discuss with that too, but keep that in mind. Try to have that target, and that will protect you financially. Okay, then to tie it into the rates, right? With the rates going up, the thing is you can optimize this now. So if your rate renews and it comes up higher, you're good. Plus, if you edit your financing now, today's rates are quite good. So what we're doing for investors, we do it all the time. We call it like a portfolio review, but we review someone's portfolio. We look at their amortization on their properties, how much they owe, what their payments are, what their interest rates are. And then we say, okay, on this property here, maybe we only save you a quarter point on your rate, but we're adding 10 years to your amortization, which is improving your cash flow by $700 a month. That's just an example, but it happens all the time. Like, literally, it's so easy. It happens. Yes, there's a cost, right? There's potential mortgage penalties and stuff like that. But by tweaking that and optimizing and stretching it out, what happens is it's less of a sticker shock, right? Because if you are at, let's just say you're at 2% still from the COVID days, and you have 20 years left of your amortization, which is what most people have, because the 30-year on first-time homebuyers and stuff, that just started coming out. So it's always 25 years. Some investors could get 30, depending on your lender and bank. But if we look at it, right, so you have 2% with 20 years left, you're up for renewal, right? Renewing at 4.5 is going to be a big impact for you. However, if you renew at 4.5 and change from a 20-year to a 30-year, it may not even phase you. Now, the negative, of course, is it's going to take you longer to pay this loan. But the way that I look at it, that doesn't matter to me, because I'm not paying it. It's not my primary home. The tenants are paying it. And that's what an investment property is, right? You set it up so the tenants pay it. So you're just tweaking how long it takes to maximize cash flow now. Now, that doesn't mean that's always the case. What if rates stabilize and then they end up being lower long term, right? Like, who knows? We can then increase your payments to speed it up. So it's not like you're stuck. You can always increase your payments. Or if you've added in a unit to the property, now the rent is so much higher, right? We can increase those payments. So just because we're bringing it to 30 years doesn't mean that's how long you need to take. So I think a lot of people think that is the case, but think of the 30-year as the minimum payment, okay? And then you can increase the payments from there. So now, by altering your payments and extending the amortization, that does protect you, because if the rates are increasing, again, and you're extending your payments, it's not putting you in that financial jam, okay? Next up is tenant quality. And this is why I think the first point of having that reserve fund is so important, because a lot of people are accepting tenants who maybe are not their ideal tenant just to get somebody, and that is a huge problem as well. That can greatly open up problems for you, because what if they are a bad tenant, and because you just, you needed that money, you just accepted them. So you don't want that. So this is why the reserve comes in so handy, is because if you can hold out longer, right? You don't have to just accept the first person that walks through the door that says, yeah, I'll pay the rent. You can pick and you can wait. And I encourage you to do so, because you don't want to get a wrong tenant that can ruin you and your portfolio absolutely. So I think the portfolio reviews are incredibly important. If the banks are right and rates go up at the end of 2027, then you need to be tapping into, the most optimized mortgage that you can now, right? To give you that 5-year buffer. That's the most popular term, is the 5-year. Some people get the 3. I don't think the 3 is good in this market right now. I think the 3 serves a purpose in certain markets, but knowing that the Bank of Canada wants to potentially raise rates. Now, again, when they do raise, it's variable, but they're synergistic. They kind of follow each other a little bit. In fact, you could look at the past 25 years history of the fixed versus the variable rates, and you'll see that the variable is usually lower, but you can see that they do kind of follow each other. So they go up and they go down together, with the exception of, the end of COVID, when they jacked the rates way up. That was an anomaly that was not seen the previous 25 years. So that was a little bit different, but that could happen again. And that's why I think it's so important to redo your portfolio, even if you have strong cash flow now. Like, even if you have fantastic cash flow, but maybe say you've got 15 years left on your amortization, switch, redo it, get 30. Again, 30, just think of it as minimum payment, not what you actually have to pay. Then when money's tight, you can keep that minimum payment, so you have a stronger cash flow. When money's fantastic, you can increase your payments and pay it off faster. So it gives you that flexibility. But if your amortization is 15 years, you can't change it back up without redoing your loan. So you're stuck, right? That's your max that you can have a payment based on. So there's all these things to consider. So anyways, I wanted to share this with you. This is happening a lot. These are what we're hearing from investors in the market, right? They're concerned. They don't know what's next. And I do think it's a great opportunity to buy. I feel like right now specifically, and here's why I think it's a great time to buy. There's not as much competition. So I think that's great, because when it's a seller's market, the bidding wars get out of hand and then properties get overpaid for. And one thing that I learned from Robert Kiyosaki way back when I first started investing is you make money when you buy, not when you sell. So if you enter investing with that mindset, we need to make money on the buy. Well, in the seller's market, it's really hard to do that, right? Unless you're finding something off market, or it's tough. But in a buyer's market, especially if you go after those listings that have been on the market 60, 90 days, right? Those people still have the home listed because they need to sell. And, we don't know why they need to sell, but they need to sell. And it doesn't mean there's something wrong with the property. It could be their realtor is, too busy and he's not screening calls properly, or being available for calls. It could be the marketing team that broker, the realtor works for, like their brokerage, maybe they didn't market it right. Like there's different things. Maybe they didn't price it right. One of the properties that I bought in the past, they had it listed in the wrong zone of the city. So they had it listed in a zone, and I don't know why. I mean, it literally shows the address, but the zone was a bad zone that you wouldn't want to buy in, but it actually wasn't located there, right? So they just picked the wrong thing. So on realtor.ca and stuff, it was showing you that it was in this area, but it wasn't in that area. So, something like that, I made out really well with. So my point here is that I think it's a great time to buy because you can get deals. You can negotiate stuff. Generally speaking, as rates go down, the purchase prices go up, right? Because there's more demand. We're entering the spring market. I feel like a lot of clients and investors are used to the tariffs at this point in time. A year ago, right? Everyone was like, what the heck is this? Everyone was concerned. They didn't want to take action because they were fearful that, they might buy a home and then lose their job in a month or two. I feel like a lot of that dust has settled, like mentally. Like I feel like people mentally, the ones that I talk to, they're much more confident going forward than they were, this time last year, which is great. But we've also had pent-up demand over the past few years because after COVID, the rates skyrocketed, right? So we had buyers that were like, whoa, it's getting too expensive to buy now. We're going to hold off. And then the rates came down, and then tariffs came, right? So that kind of delayed a little bit more because I was actually expecting last year to be fantastic as far as, buyers coming out there and the market just being crazy. So anyways, I do think there is buying opportunities. I think investors are targeting more multifamily. That's what we're seeing. We're seeing a ton of U.S. stuff and a ton of multifamily in Canada. Those are like the two biggest areas that we're seeing investors invest in. So anyways, just wanted to share this all with you. I hope this helps. I hope it added value. If it did, please like, please follow, share with a friend. And of course, if you have any questions or want to book a call with an expert on my team, the link is in the description below. Thank you so much. Have a great day.